Hello everybody, welcome to another episode of Erickson TV. We're on part 3 of our Erickson Summer Series Back to School about passive investing.
That's
and,
right.
So please go back and look at the previous 2 episodes if you haven't in the archive. And Lauren, we talked a little bit about, in the first episode, about the benefits of passive investing.
Right.
Capturing market returns at the lowest cost.
Right.
And we talked about some investment legends such as Warren Buffett and Charles Schwab that are strong proponents of passive investing.
Right.
However, we saw that there were some deviations. Deviations from Schwab was that they're promoting heavily these style ETFs that perhaps aren't as diversified as we want them to be. But then the one that I wanted to talk about today is Warren Buffett talked about his estate plan, where his wife is going to basically put her entire inherited nest egg. 90% of it will go into the S&P 500.
Right.
You have an excellent seminar that I have done a version of it too, that we talk about the indexes that make a difference.
Right. Yeah. You know, that's an interesting point. I did and I didn't even realize what the results were going to be. I did a little study where I just looked at the last 10 years of the Dow Jones Industrial, which is the 30 largest U.S. companies, the S&P 500 index, which is the 500 largest U.S. companies, and then the Vanguard Total Stock Market Fund, which is all of the U.S. companies. And I just told it to make a graph of the last 10 years and draw lines. And when you display the picture, many people can't even see that there are 3 different lines. It all just looks like one line because the performance is so similar. You know, even the total stock market is just absolutely dominated by the largest U.S. companies. So then, the next slide shows indexes where it's like, okay, if the U.S. stock market is dominated by the 30 largest companies, what could you invest in that isn't going to give you the same result, but that also is still diversified?
Right.
So so I'm not having to recommend you something that has like 10 stocks in it or something ridiculous.
Like a Schwab ETF.
Right. Yeah. and of course, the things that really diversify are, first of all, investing in the corners of the market that include smaller companies and what we call value companies, which, for the purpose of this video, value just means low price.
Right.
They have low prices. So stocks that are small and have low prices relative to their book market, these are stocks that really do act differently, and you can still get a very diversified portfolio, lots and lots of them. And then, of course, the second place you can go, many people have noticed that the international markets don't seem to be offering quite as much diversification as maybe they had hoped. But if you not only invest in international stocks, but you are also willing to invest in, again, small stocks of international stocks, or emerging market stocks, or small stocks of emerging market stocks.
Value,
yeah, exactly. Then you have indexes that are still quite diversified, but that actually do something very different from the rest of the U.S. stock market. And so even if the expected returns are similar, and they're often not, but even if they were similar, simply the fact that they move up and down at different times benefits you when you construct a portfolio.
Right.
Because it lowers your overall risk of the entire portfolio. Maybe it doesn't lower it that much, but it lowers it a little bit.
So to end this episode, unlike Warren Buffett's plan for his wife, which is very simple, simplicity is beautiful. The beauty is about that. But you and I both agree that there are some indexes that make a difference, and that it can be constructed to still be a relatively simple portfolio, but you'll actually see a difference in the returns.
Yes, that's exactly right.
All right. Thank you for watching this episode of Erickson TV. We'll see you next time. Bye now.
See you next time.